If you're looking to invest in the S&P 500, you've probably heard of SPYI, VOO, and maybe even covered called funds like JEPI and XYLD. But which one is the right strategy for you? Is it growth, income, or a mix of both? In this video, I'll break down the performance of SPYI, VOO, JEPI, XYLD, SPYI, and XDTE over the last 2 years, 1 year, and 6 months. And I know some of those maybe you haven't heard of, but we'll get into defining those really shortly. We'll dive into the NAV changes, total income, if you lived off the dividends, and how reinvesting those dividends could actually impact your long-term results. So let's get into it. All right, to keep things simple and fair, I'm going to use a $100,000 lump sum investment for each fund at the beginning of each time period. So at 2 years, if you invested $100,000, how would that have performed over 2 years, over the 1 year, and over the 6 months? We'll explore how these ETFs performed across different market conditions, and that can help you decide which might be the best fit for you and your goals. And remember, this is not investing advice. This is more just to educate you on how these can perform so you can craft your own strategy. All right. So first, let's get into what the strategies are, this is best for, and some quick takes on all of these ETFs. All right. So let's get into who these are for. So this is SPYI, the SPDR S&P 500 ETF Trust. So this is one of the ones you may know, and VOO will be one you know too. So this tracks the S&P 500 index, and this is best for investors seeking liquid, growth-oriented exposure to the S&P 500. So this is one of your buy and holds. It's known for its size and its liquidity. SPYI is often the go-to for traders and long-term investors alike. Like I said, you can buy and hold, and you can even sell covered call options on this if you wanted to. Okay, next we're going to go into VOO. This is the Vanguard S&P 500 ETF. So similar to SPYI, lower dividend yield, but this has the lowest expense ratio of them all. So 0.03 expense ratio and a 1.22 30-day SEC yield. So looking at VOO, the strategy here, this also tracks the S&P 500 like we talked about with the lowest expense ratio, much lower than SPYI. It's best for long-term investors focused on cost efficiency. So this offers near identical, if not better sometimes, performance to SPYI, but at the lower cost. This one truly is a buy and hold, and then you just set it and forget it. So if you just keep buying dollar cost average, and that's the investor you want to do, VOO is the one for you. Next is JEPI. This is the JP Morgan Equity Premium Income ETF. So this is, the strategy here is actively managed, and it provides high income with some market upside. So this is best for investors that are seeking reliable monthly income with a bit of growth. So this, in terms of NAV, won't perform as well as VOO and SPYI, but at a higher dividend yield. So if you look here, the dividend, the 30-day SEC yield is at 7%. And I think the overall dividend for last year was somewhere in the 9 to 10% range. So you can look that up. But that's JEPI. If you saw my last video, they have a similar product for the NASDAQ 100, which is JEPQ, not to be confused. Okay, next is XYLD. This is the Global X S&P 500 covered call ETF. Similar strategy. Global X has been around doing it a lot longer. It's a covered call ETF, so they sell covered calls on the S&P 500, and they prioritize income, not necessarily overall growth. So here, this is best for income-focused investors that aren't necessarily concerned with some NAV erosion or potential loss of upside compared to VOO and SPYI. So you look at here, the trailing 12-month distribution is 12.63%, much higher than the sub 1% of SPYI and VOO. All right, next, let's look at SPYI. This is the NEOS S&P 500 High Income ETF. So this combines that S&P 500 exposure with a covered call strategy that also generates income. So if you look here, again, high distribution rate, 11.91%. They distribute monthly. Same with XYLD and JEPI. I forgot to mention they distribute monthly. 0.68 expense ratio. And so this is best for investors wanting income with moderate growth potential and some tax optimization. You can look more into how they do that here, but they do have better tax and growth upside than, say, JEPI. Okay. And the final one we're going to compare is XDTE, which is the Round Hill S&P 500 Zero TTE Covered Call Strategy ETF, which uses synthetic covered calls. So this strategy seeks to provide overnight exposure to the S&P 500 and generate income each morning by selling out of the money Zero TTE calls on the index. So This is much different. This has the highest distribution rate at 63%, but they also pay weekly dividends. So that's something to consider if you are an income-focused investor looking for high yield plus weekly income. And so the quick take here is this is ideal during volatile or declining markets. You may see some NAV erosion, which we'll look into some of the data here. And this is only launched in March of last year of 2024. So we're only going to see this in the last comparison when we do the 6 months of, meaning July to December of 2024. All right. So that goes into the quick overview. Now let's get into the comparison on how they performed. All right, and let's go. So starting off at the 2-year analysis. So we have SPYI, VOO, JEPI, SPYI, XYLD, and XDTE. So looking at, start with a $100,000 investment. The number of shares, you'd have 260 for SPYI, 283 for VOO, 1,827, 2161, and 2527. XDTE wasn't around, like I said earlier, wasn't founded until March of 2024, so they're not participating in this. So when we look at how much you would have made if you didn't reinvest, so if you lived off your dividends, so dividend income here, the winners are SPYI and XYLD, which had the highest dividend yield. But you look at without reinvestment, the highest return would have been SPYI and VOO. And looking at the NAV change, so the asset value change, by far the largest increase in growth would be VOO and SPYI, which makes sense, right? These are long-term investments for 2 years. This is what you would have seen. Now, living off of dividends, though, this is where it might be different. So living off of dividends here, you'll see that SPYI, for that $100,000, over the course of the 2 years, you would have had almost $24,000 in total dividend income. And then looking at XYLD, you'd have almost $22,000 in dividend income. So if you put that across 24 months, you can see about $1,000 a month you would have made roughly if you lived off the dividends. Okay. And now looking at total reinvestment, what would have happened if you would have just let it compound and you would have reinvested your dividends daily or whenever their dividends would have come out? And then we're going to look at total reinvestment in total value reinvestment. And by far, again, VOO, SPYI, this is what they're designed for. They're designed for this long-term growth. But you look at here, SPYI, $137,000 at the end of the 2 years, XYLD, $130,000. So you didn't see a lot of NAV erosion. You actually saw a good amount of growth across all the investments. Now let's look at the 1-year scenario, looking at VOO, SPYI, and these still. Okay, so now we're looking at NAV change. So similar story here, VOO, SPYI are the winners if you didn't invest or if you did reinvest your dividend income. But we're going to look at dividends per share. Also, if you lived off the dividends, you would look here, VOO and SPYI in that year, you would have made maybe a little more than $100 a month. So just something to consider. If you invested in XYLD and SPYI, you would actually be taking home about $1,000 a month. So, and zero to no NAV erosion. So all of these, even if you didn't reinvest the dividends, they grew in 2024. So you look here with that $100,000, even with XYLD taking all those dividends, you'd still have $116,000. So this is something to consider too. If you need the income right away, looking at what your income could have been versus the NAV erosion, which there was no NAV erosion across the board here. And then if you were to reinvest dividends, if you're a set it and forget it, buy and hold, and you're reinvesting, we'll look at $125,000 for VOO, $125,000 for SPYI. This is not bad if you're looking at JEPI, XYLD, and SPYI. Either way, you saw some growth in your portfolio. But interestingly, look at JEPI, if you didn't reinvest, you would still have $112,000, making roughly $7,000 in dividend income. But if you'd reinvested, maybe not have been a great idea across the course, because reinvestment, also keep in mind, that takes into account you're buying in with those reinvestments at the stock price for that month. So there's that. And then let's move now to the 6-month analysis on these stocks. So now we're going to get XDTE, which is the 0 DTE synthetic cover call strategy and pays weekly dividends. So we'll look here, you're starting to see some NAV erosion, or actually no NAV erosion, sorry about that, but you're only seeing single digit, which makes sense because it's only a 6-month period, right? So if we didn't reinvest, let's see who the winner is here. Interestingly enough, XYLD and XDTE, if you didn't reinvest, actually outperformed VOO and SPYI, given that you would have invested $100,000 on July 1st of 2024, But that's interesting, right? Just to see that bit of data. Now, if we look at total income, if you lived off of those dividends, XYLD and SPYI are the winners here. For 6 months, you would have made more than $1,000 a month if you took that dividend income for the XYLD, and you would have made, a little less than that if you were going with SPYI. Not too shabby though for XDTE for paying weekly dividends. So if you're needing that weekly income and you're okay sacrificing some of the growth, because it did have JEPI and, well, actually it had a good amount of growth. XDTE did have a good amount of growth, but looking at see if this is a way you'd want to balance your portfolio. So remember, this is just data I'm sharing with you. So for you to help you make your own informed decision. By no means, again, is this investing advice. I actually have holdings in all of these except for XYLD, which I sold out of, which is a whole nother video. You can watch that after you watch this one. Okay, now looking at total value with reinvestment, XYLD is a clear winner here. XDTE coming in second. Remember, this is only a 6-month snapshot, but it is interesting to see that if you reinvested dividends, these two ETFs actually outperformed SPY and VOO. Not by much, but still interesting to see that outperformance. Okay, so that's just some data comparing the 2-year, 1 year, and 6-month performance if you were to do an apples to apples comparison. One thing I did want to show is also just how some of the trends that you would have seen over this time. And keep in mind, remember that XDTE started in March, so you'll see it only starts here. And then SPYI didn't go the full year, so you'll see it just started here. But looking at trend lines, some of these trends are very similar to the indexes that they're running off of, right? But you look at some of the performance, of course, over time, this is going to grow substantially. But the interesting here is if you reinvested dividends, the performance is not that far off. So if you look at SPY, how it performed, it's right in line, especially the last year, 6 months to a year, it's right in line with SPY and VOO if you reinvested dividends. Like they're very close. They're all bunched in here. JEPI is the kind of the medium of the bunch, and then XYLD, XDT pulling up at the rear. But one thing to look at are sort of these trend lines. They trend very similarly. And you can see JEPI is a little less volatile than SPY and XYLD and XDTE. Looking at these sharp drop-offs, the drop-offs here for JEPI weren't as pronounced. So just something to consider if you are investing in the S&P 500 and you're looking at which way you want to invest, if you're income-minded, growth-minded, or if you want a blend of both, just some things to look at. My own personal portfolio, I do have SPY and VOO in my long-term retirement accounts. And then I do have holdings of JEPI, SPY, and a very small amount of XDTE because I am curious about how it's going to perform over the course of 2025. So those are more my retail accounts that are more focused at income. So I like to have it balanced. I'd love to hear from you in the comment sections below what you prefer. Are you an income-focused investor? Are you a growth investor? Or you like a balanced? And what is your mix? All right. Hope you all got some value out of this. If it doesn't challenge you, doesn't change you, thanks for watching. If you haven't subscribed already, please do. Hit the thumbs up button. It'll really help me out with that algorithm. And I will see you in the next one.